You ever see a company announce fantastic results, beat all the expectations, and then you watch its stock price just fall off a cliff? Well, that is the bizarre story of John Deere's recent quarter. On paper, everything looked great, but in the market, it was a total bloodbath. So today, we're going to unpack this paradox.
Okay, so let's just lay it out. On one side, you have the good news. Deere posts earnings of $4.75 a share, revenue over $12 billion. Both numbers beat what Wall Street was expecting. That's a classic win, right? But then, on the other side, the market reacts by hammering the stock, sending it down nearly 8%. That was its single worst day in more than 3 years. It doesn't seem to add up.
So what's the deal? What did the market see in those numbers that the headlines completely missed? Let's get into what was really going on here. All right, to solve this little mystery, you have to get one fundamental rule of investing. Wall Street doesn't really care about where a company has been. It's all about where it's going. You see, those strong third-quarter results, that's a snapshot of the last 3 months. It's history. The market, though, was laser-focused on the road ahead. And that is where we find the smoking gun. Tucked away in that same earnings report was the one detail that mattered most. John Deere lowered its financial forecast for the rest of the year, and that was the warning flare that sent investors running for the exits. So before, Deere had told investors it expected to earn as much as $5.5 billion in net income for the full year. The new forecast? Well, it capped that number at $5.25 billion. Now, you might be thinking, a $250 million cut, is that really a big deal for a company this massive? Well, it's not about the exact number. It's about the signal. It tells the world the company sees some serious turbulence ahead. And for anyone who's not totally clear, what exactly is guidance? Think of it like a company's own report card for the future. It's their projection, their promise to Wall Street. And when a company lowers its guidance, it's like telling your parents you expect to get a C after promising you'd get an A. It almost always triggers a wave of panic.
Okay, so that leads to the next logical question. Why the sudden caution? What's out there that has Deere so worried? Well, it turns out they aren't just seeing a few clouds on the horizon. They're sailing right into a perfect storm of global headwinds.
For starters, let's talk about the big one, tariffs. Deere is now bracing for a $600 million hit to its bottom line just this year. That is a massive, unexpected cost that they basically just have to eat. But it goes way deeper than that. Demand for their iconic green tractors is getting squeezed from all sides. There's a glut, a huge oversupply of used equipment on the market, which makes it way harder to sell brand new machines. High interest rates are making those enormous loans for new combines way more expensive for farmers. And on top of all that, you've got low crop prices and trade uncertainty. It all just means farmers are tightening their belts and thinking twice before spending big. So, faced with this storm, Deere isn't just sitting back and hoping for the best. Nope. They've shifted to a very deliberate defensive playbook. They're focusing intensely on, as their executives like to say, controlling the controllables. And you can hear it straight from the CEO, John May. He said their goal is to perfectly match what their factories are making with what customers are actually buying. It's a really disciplined strategy. It's designed to prevent a huge pileup of unsold tractors and combines, creating a much healthier market for when things eventually turn around. So what does this defensive playbook actually look like? Well, it really boils down to 3 core moves. First, you deliberately and proactively cut production. Second, you get aggressive about clearing out that glut of used inventory. And third, while you're playing defense on those fronts, you actually go on offense by doubling down on your biggest long-term bet, technology. And believe me, when they say they're cutting production, they are not messing around. Just look at North America. Their inventory of new large tractors slashed by a massive 45% compared to last year. Combines are down 25%. This isn't just a small tweak. This is a hard, decisive pivot. And to tackle that used equipment problem, they're getting pretty creative. They're using a tool called pool funds, which basically helps their dealers offer better, more attractive financing deals on all those pre-owned machines. I mean, in a world with high interest rates, making a used tractor more affordable can be the single thing that closes a sale. But even while they're managing this downturn, they're pushing full steam ahead on tech. A perfect example is their new satellite connectivity service, JDLink Boost. In just its first year on the market, it's already pulled in over 5,000 orders, connecting farms in even the most remote areas. And look, this isn't just tech for the sake of tech. It delivers real, measurable value.
Customers who are using their new automated harvesting technology are reporting a 30% increase in throughput. That is a huge productivity boost for a farmer, and it shows their tech investment isn't just a bet on the future, it's paying off for their customers right now. So with all these challenges and all these strategies in play, what does the road ahead actually look like for John Deere? Well, if we zoom out and look at the global picture, we get some really crucial clues. You can see it right here. The real pain is concentrated in North America. The whole industry is expected to be down a staggering 30%. But look elsewhere, and the picture's totally different. Europe is pretty stable, South America is flat, and Asia might actually see a little bit of growth. The problem is, North America is Deere's biggest, most important market, and its weakness is just dragging everything else down with it. But despite that pretty gloomy forecast, Deere's leadership is projecting total resilience. The company's CFO, Josh Jepsen, made a point to remind everyone that, look, they've been through this before. Navigating these cycles of boom and bust, he says, is just part of their DNA. So when you put it all together, what do you get? John Deere is playing the long game. They're taking the short-term pain, right? Making these disciplined cuts to inventory and production, all while betting that their long-term investments in technology will let them come out of this downturn stronger than ever. The big question that hangs over the entire company and its stock is a simple one. Will that patience pay off?